Hello everyone, investment scams rampant. Please vigilant and discerning. Do not trust information from unknown sources. Please make sure to recognize 2 official Capital Securities community, Facebook, Capital Securities, YouTube, Capital Wealth Insights.
Hello everyone, I'm Tony Dom Jiaching. Now let's begin today's group session. Good evening. First, let's take a look at the 2 main topics for today. The first is, was yesterday's stock market drop all caused by Trump and Powell talking nonsense? Second, let's see if there's a possibility of a change in tech stock trends. This morning, we saw reports from Juan-Hing Net and Bowen Sean, both saying Powell poured cold water on the market. He said stock valuations are quite high, and as a result, U.S. stocks fell. But we need to point something out. On Monday, we talked to everyone about the chaos in the market. The first thing last week was Trump. After the summit last week, there was confusion because soybeans were not discussed. The second thing was the confusion caused by Trump regarding the H-1B visa issue. Another source of confusion is the Federal Reserve. On one hand, they're raising their economic forecasts and increasing their PCE projections, while at the same time they're cutting interest rates. This is also a source of confusion. You see, all of this is happening under a rather confusing backdrop. The decision was just made last Wednesday afternoon, U.S. time, and now, less than a week later, he has to speak again. In my view, Powell's speech yesterday, in theory, shouldn't have been too aggressive. He shouldn't have taken a particularly hawkish or dovish stance. Why? Because the previous decision was already seen by the market as somewhat contradictory. So, as we'll see in a moment, Powell's remarks yesterday were actually quite measured and didn't go to any extremes. The issue arose when Powell was later asked whether he was concerned about the stock market rising too high. In his response, he said a few things, and then added, "You're right, by many measures, stock valuations are on the high side." So, naturally, the whole market got nervous because of this comment and started to turn downward. But what we need to talk about is, there have been Fed chairs in the past who criticized the stock market for being overvalued. If I remember correctly, Greenspan famously talked about irrational exuberance. That's the most well-known example. After that, both Bernanke and Yellen seem to have made similar comments about valuations being high, and those did cause some market reactions. But in reality, the actual development and changes in the market still depend more on the stocks themselves, not just on what the Fed chair says. The market's overall trend doesn't just turn around because of a single comment from the Fed chair. That's something we need to pay attention to. Now, regarding the topic of the stock market rising too high, I actually don't think that's the case here. Yesterday's drop can't be entirely blamed on Powell. In fact, Powell didn't start speaking until around 12:30, but the issue is, even before the market opened yesterday, when we talked to everyone, we saw that Nvidia and Oracle had already dropped during the previous day's trading. At that time, I mentioned that the market didn't look too good yesterday. But if we look at it, actually, after the S&P opened at around 9:30, there wasn't much. It wasn't until 10:30 it stabilized in the negative, then slowly dipped more. After Powell spoke, it turned into a bigger drop. I don't believe the market as clever predicted what Powell was going to say. No one could have known in advance what Powell was going to say yesterday, especially since, if there really was a prepared speech released beforehand, the content of that speech was actually pretty neutral and balanced. It was only when he was answering questions that he added a comment about the stock market being a bit too high, and that's what caused the bigger drop. We'll look at his chart in a moment, and actually, this drop, was indeed a decline, but it wasn't an especially dramatic pullback. I think, looking at it from this angle, the bigger issue isn't really here. We'll discuss this in more detail with everyone in a bit. So, did Powell really pull back? Actually, all he did was reiterate that we need to stay vigilant about inflation and that there's no risk-free path for the Fed's decisions. He basically said that choosing between employment and inflation is a tough call, and then he said that some people in the market are also using this as a reason for the drop, saying that Powell didn't reveal whether the Fed would cut rates at the October meeting. First of all, this was always going to be a decision based on economic data, meaning if the jobs report turns out worse, then they'd consider a rate cut. But right now, it's still too early. We'll have to wait for next month's jobs report before making any calls. I don't think there's any need for him to say anything about a rate cut at this point, especially since it's been less than a week since the last rate decision meeting. Unless a rate cut is already a done deal, there's no reason for him to announce anything about October. And as you know, for most Fed officials, you can see from. If you look at their recent statements, it's actually a bit like this. First, some of them were spooked by the previous jobs numbers. Second, some are definitely feeling pressure from President Trump. Of course, they're also denying that they're being influenced by the political environment. They're denying that they're being manipulated by political forces. But in reality, the relationship between the Fed and the president is pretty tense right now, and that's just a fact. He also mentioned that we need to stay vigilant to prevent tariffs from causing lasting inflationary effects. Honestly, if you just look at what Powell said, in principle, it's not really any different from what he said at last Thursday's post-meeting press conference. The only part of his remarks that really worried the market was that one sentence about stock prices being a bit high, and that's what caused the market to drop. So, if we look at this, we'll have to see whether stock prices will fall. Let's check the performance of tech stocks in a bit. But as for interest rates themselves, the Fed's, Nick Timiraos, the Fed's mouthpiece, published another report yesterday. He played his role as the Fed's mouthpiece well, offering a clearer interpretation for everyone and sharing his insights. What he meant was, the current interest rate level is still considered to be at a restrictive stance. He said that, in his view, if the labor market continues to weaken more than inflationary pressures, then there could be further room for rate cuts this year. In other words, next, upcoming employment reports softer, weaker, not too strong. Rate cuts more likely, continued rate cuts. My view, rate cuts is still in the underwater zone. They've only cut by 25 basis points, bringing the rate to the 4 to 4.25% range. Core inflation is around 3.1%. As long as rates are cut to 3.25%, the market should remain relatively safe. After it drops to 3.25%, it should be much closer to the inflation rate. If inflation drops further, that's even better, as it gives more room for rate cuts. As long as inflation doesn't rebound sharply, that space for rate cuts remains. It's only when rates reach somewhere between 3.25 and 3% that we enter what's called the deep water zone. At that point, the Fed chair will have to decide whether to bring rates below the inflation rate. However, this is likely something the new Fed chair, who takes office after May next year, will have to deal with. So, from my perspective, I also believe that there is still room for another rate cut this year. The real challenge, the deep water zone, won't be encountered until the first half of next year. So, Before the end of this year, I think monetary policy should still largely meet market expectations. Just like James Bullard said, cutting by 50 basis points last week, or cutting by 25 in September and another 25 in October, amounts to the same thing. I think a gradual approach to rate cuts isn't a bad thing for the market. There's no need to rush, and in fact, a more measured pace is better for the overall financial markets. Additionally, when it comes to the Fed's monetary outlook, the policy outlook from now until the new chair takes office next year, I feel the same way. The key still comes down to that man, and I'm not talking about Powell, but the man after him, Trump. What kind of monetary policy Trump really wants will determine the direction of the Fed's policy. Of course, what he wants is an easy monetary policy. I think unless inflation really gets out of control and employment isn't too bad. In fact, if employment isn't too bad and rate cuts are slow, the market will interpret it as the economy not falling into recession while rates are being cut. Remember the RBC scenario we talked about yesterday? If that's the case, the probability of a rebound and positive returns in stocks is higher. If so, this would actually be the best outcome for growth stocks. So, once again, I want to tell everyone that I personally prefer a gradual rate cut, and by the middle of next year, to see inflation also gradually trending down. This would create room for rate cuts, and the effect could be the best for the stock market. I also want to mention one more thing. There's another perspective on Bloomberg that everyone should hear and keep in mind. Bloomberg has. Some members of Bloomberg's economic research team believe that even the recent Southern payroll, that is, the non-farm payroll numbers, are now possibly at a point where what you're seeing might be close to the bottom. What does close to the bottom mean? It means if you look back months later, you'll realize this was the bottom, and after that, it stops going down and starts to rise. But we must point out this is, of course, a prediction based on analytical models. Secondly, and more importantly, you can only really tell after time has passed, meaning you might not realize until May or June next year that this summer's non-farm payroll numbers were at their lowest. So this is important. We must understand that you have to feel your way through as things unfold. As you cross the river, you have to watch both the economic data and the market changes and judge whether the employment situation has been eased or even reversed after this rate cut. This was part of what Powell talked about in his speech yesterday. Since Powell spoke, let's also catch up on what other Federal Reserve officials said yesterday. First, there's Grosby from the St. Louis Federal. He said that the Federal Reserve should remain cautious about further rate cuts. His remarks are relatively more conservative. His comments are more traditional for a Fed official. Let me point out something here. If you look at recent statements, generally speaking, the so-called regional heavyweights, meaning the presidents of the 12 regional Federal Reserve banks. These are the heads of the Fed's regional branches. Whether you call them presidents or chairmen, the point is, they are the leaders of the regional banks. On this side, the regional bank heads actually tend to take a more hawkish stance on inflation. But remember, they take turns voting, so among the Board of Governors, their attitudes are more split into two camps. There are both doves and hawks. Now, let's look at the dovish members. For example, Vice Chair Bowman said that as the labor market slows, policymakers face the risk of falling behind the curve, so it's necessary to decisively cut rates. That's a more dovish statement. But then you have Bostic from the Atlanta Fed, who said that with inflationary pressures coming, it's important to stay vigilant about prices. That's a more hawkish view. So, does this match what I just mentioned? The regional bank heads usually take a more hawkish stance on inflation, while the board members are more likely to have a dovish perspective. Of course, there are also some members who are more dovish about rate cuts, but overall, the focus still tends to be on inflation data. Additionally, let's mention that recently, Lister, Milan, Vice Chair Bowman, and Bostic from Atlanta have all brought up the idea of setting an inflation range, rather than sticking rigidly to a hard 2% target. Whether this adjustment to a range will become the new direction under a new chair is something we'll have to keep watching. It's possible things could move in that direction. However, if they do set a range, another way to interpret this is that with a range as the target, they might not prioritize implementing Trump's ideas. As for whether Trump will come out and criticize this approach, we don't know yet. We're just telling you that replacing a rigid inflation target with a range is currently being discussed. We might see corresponding adjustments being made in response. Next, let's take a look at the news in the United States, because things have still been pretty chaotic there lately. The H-1B news, in particular, has continued to be a hot topic, with ongoing reports about it. The impact has actually been bigger than I expected, because I thought the market would react quickly and be done with it. But it seems that a lot of American companies, scholars, and related media have all been covering this issue. So, it looks like Americans really care a lot about the H-1B, mainly because it's a source of top talent for them. For other countries, like China, which only accounts for 12%, I showed you that number yesterday. The proportion of H-1B holders from China is about 12%. It might be different. For China, and also for Korea, the approach might be different, maybe because of the number of people involved. Since the number of people isn't large and the proportion isn't high, and the domestic economy is doing fine, they might as well just call their people back and not have them go to the US to help out anymore. Americans go abroad to work and then come back. That's basically the idea. But for India, since they have a much larger population and their domestic economy isn't doing so well, they have to send people abroad to work. It's essentially exporting labor, kind of like foreign workers or migrant laborers. In fact, you can think of them as skilled migrant workers. So for India, this is extremely important. When I saw this policy being pushed by Trump back then, I felt that he simply wanted to solve the problem of American STEM graduates having a hard time finding jobs this year. He probably also heard that some people use the H-1B program to bring in cheaper foreign workers, which means local Americans end up not getting those jobs. So, of course, this was more of a short-term, immediate decision, and that's why he rolled out this policy. Impact still significant. S&AMP wink with thumb sticking out released PMI. S&AMP wink with thumb sticking out doesn't publish detailed breakdowns, so we're looking at headline numbers. Composite PMI dropped 54.6 to 53.6. Manufacturing PMI went 53 to 52. Services fell 54.5 to 53.9. All still expanding, but pace slowing, leading to hiring slowdown. Right now, everyone is paying more attention to hiring because the non-farm payroll report, which dropped sharply before, is a key focus. Let me also remind everyone about the S&AMP wink with thumb sticking out PMI, which is the former market PMI. This PMI is more influential in Europe, but in the US, the ISM index has a much longer history, and its survey methodology is almost uniquely American. So, when it comes to PMI, Americans definitely focus on the ISM, especially the manufacturing and services indices. Plus, ISM is more transparent with its detailed breakdowns. You can actually see the specific numbers. So, this makes it easier to analyze. In other US news, there's also a series of statements coming up from Trump. Trump said he mentioned that because there have been recent reports of Russian planes invading the airspace of Estonia and Latvia under NATO. The location is above the Baltic Sea. Let me quickly explain. Russia actually has an exclave over there, and technically, they have the right to pass through this airspace to reach their exclave. However, this flight path is very close to Finland and also very close to. It should be Lithuania. Let's just say it's Lithuania for now, though I might be remembering the country wrong. But the point is, the issue is that this flight corridor hasn't been previously coordinated or agreed upon, so both sides keep accusing each other of airspace violations. Actually, this kind of thing happens every year. It's pretty common, and it's not particularly serious this time. It's just being blown out of proportion. Trump probably doesn't really know the details. He just says you can shoot down their planes. Well, you'd better hope that the NATO troops or those soldiers on the front lines don't get hot-blooded and actually shoot down a Russian plane at a time like this, because then we'd be looking at the start of World War III. I can guarantee you that. In addition, Trump had a rather strange statement. Yesterday, he made a surprising comment. When he met with Ukrainian President Zelensky, he said something. Ukraine can say that the US has not yet provided weapons to NATO, so it implies that Ukraine can keep fighting Russia and possibly reclaim lost territory. On the surface, this sounds quite touching, but the problem is that Ukraine's combat strength has seriously declined. Even if they get money and weapons, they might not have enough people left to fight. That's a bigger issue. The Syrian president said that his new president, Shala, wants to meet with Trump. Also, Trump continued yesterday to talk about preparing to impose new tariffs and sanctions on Russia. He repeated once again that only when European countries stop buying Russian oil can the Russia-Ukraine war be effectively ended. However, let me tell you, these kinds of statements, along with his talk about taking down Russian planes, are actually helpful for oil prices. But I have to say, basically, I think these are things that just can't be done. Because within these European countries, division is a defining feature. Everyone has their own opinions, and many will secretly buy oil from Russia. So there's no need to laugh at others or judge who's more noble. I'm just saying this is very hard to carry out. Yesterday, Trump went to the UN General Assembly in New York to give a speech, and he went all out, blasting the UN. He called it a place full of empty talk, and then he also said that climate change is a hoax and that open borders will destroy the country. These are basically some of his main campaign points when he's running for office, and then, besides calling the UN a place for empty talk, it was pretty much what you've heard before. But there was one more thing. President Trump yesterday refused an opportunity to meet with the Democrats this Thursday, that is, today. Senate Democrat Chuck Schumer and House Democrat Ms. Jeffries, both from the minority party, were supposed to meet with him. Since the Republicans currently have full control of Congress, both Schumer and Jeffries are in the minority. They were supposed to meet, but the problem is that Trump suddenly said he won't meet with them anymore, and that's a bit of a problem because now Although the budget bill actually passed, the Appropriations Committee has been unable to get it through. If he wants it to pass now, he needs 7 more votes before it can go through. He needs to reach a minimum threshold. The requirement is that after getting 7 votes, a simple majority isn't enough to pass. That won't work here. It seems there's a restriction, maybe 60 votes or so, before it can go through. The problem is, those crucial 7 votes are just like our current ruling party, missing a few, so they don't have enough. If Trump doesn't cooperate with them, then at the beginning of October, we'll see a show called the U.S. government shutdown. We might have to watch this play out all over again. At the same time, the OECD released a forecast yesterday. Overall, it has raised the GDP expectations for most countries. It says that the preliminary effect brought by tariffs is actually economic growth driven by front-loading, meaning people rush to buy goods before tariffs hit, which boosts the economy, rather than the tariffs themselves causing a direct impact on demand. However, it also points out that the shock to demand caused by rising prices is something we should expect to see in the future. Now, it's important to mention something here. The main point is that the U.S. GDP growth rate is projected to be 1.8% this year and 1.5% next year. These numbers might seem a bit low, because previously, due to issues left over from the pandemic, the U.S. had growth rates above 3.5%. But we need to note that the true long-term average growth rate for the U.S. economy is around 2.5%. So 1.8% and 1.5% are indeed below average, but the key point is that the economy is still growing. There are signs of a slowdown in the U.S. economy, but it is not slipping into contraction. That's a very important distinction we need to make. Let me remind everyone again, the U.S. economy is currently slowing down, but it is not in a recession. If this situation continues, and if monetary policy can be loosened smoothly to stabilize the job market and demand, then the U.S. economy could adjust and then return to growth. This would be the best scenario for the stock market. Additionally, let me also add a piece of news about China. This could be seen as a goodwill gesture from China in the context of U.S.-China negotiations. The U.S. has long criticized China, saying that China still enjoys the so-called developing country status under the WTO, which the U.S. refers to as special treatment or something similar. The U.S. has been criticizing China for this, and this time, China responded at the United Nations by also making a statement, saying that they would voluntarily give up this status. This aligns with the U.S. position and seems to be a way to eliminate this issue. The benefit here is that it shows goodwill toward the U.S., but there is also a potential risk involved, which is that China is confident in its own economic strength, so making this concession now, whether it's really out of goodwill or just out of self-confidence, or maybe even an inflated sense of confidence, we'll have to wait and see. I'm just saying that both possibilities exist. On the other hand, if this really is a gesture of goodwill, then we can be more optimistic about the possibility of the US and China reaching an agreement by the end of this year or early next year. Right now, both sides are still keeping things under wraps, but we still want to tell everyone that we hope to see a trade agreement between the US and China. If they can reach an agreement and stabilize trade, it will be good for the whole world. Also, As mentioned yesterday, the U.S. government, specifically the Biden administration, has proposed a financing plan for lithium mining investments. Now, it seems like they might actually take a stake in this American lithium mining company. Of course, the stake would be capped at 10%, which is the maximum allowed. This company mainly has a joint venture with General Motors. This American lithium mining company actually isn't based in the US. Even though it's called America, it's actually a Canadian company. But since Canada is also part of the North American continent, calling it America isn't really a big issue. It's just that the US government wants to play a role similar to what it did with MP Materials, the rare earth company. They want to take a stake and make sure they have control over key mineral resources. Of course, with this news coming out, the stock price of this lithium mining company naturally soared. Next, let's look at yesterday's market, specifically tech stocks. Has there been a shift? The Magnificent Seven took a big hit yesterday, and the index. The 1.55% drop is actually quite large. Of course, it is a high-end black candlestick, which may cause its rise to pause and then take a break. But let's first talk about its short-term trend. In the short term, its index and its 20-day line are actually a little different, so it is possible to take a break and consolidate here, and then wait for the moving average and index to align. There are several reasons that may cause this correction. We will look at Google later. We will take a look at the 7 giants later. We will take the time to look at them one by one. This will be more appropriate at this time. We may need to take a closer look at the changes in the stock holding trend. Google fell slightly yesterday. It is still very strong. Since that time, I remember the first one is the announcement that his antitrust lawsuit does not require a split, but some adjustments are required. The other one should be his corporate financial report or similar news. It should be the company's September. I remember it was part of the antitrust lawsuit that caused his stock price to jump up and then go all the way. Similarly, we have to say that if there is a break here, don't be too surprised because the short-term deviation and the cross-line deviation are still very large. So the gap in the military line, this index position is 251.6620, and the Japanese military line is still at 235.286. There's a possibility of a slight consolidation. So let's mention it here. From the perspective of Google, this should be benign. Yesterday, Apple also fell. The main reason is that the U.S. Department of Justice has its antitrust lawsuit. However, for this lawsuit, several major IT companies in the U.S. have never stopped facing antitrust lawsuits. Whether in the U.S. or Europe, they are ongoing, so I don't think this is the reason for its drop or a true sign of weakness. Similarly, in the short term, its recent movement has been much the same. The 20-day moving average is still at 237.15, while the stock price has dropped to 154.43. This is also an excessive deviation, another possible factor. But most importantly, the key for Apple still lies with the iPhone 17. If the iPhone 17 sells well, the stock will still be in a good position. The market is really watching the foldable phone expected in 2026. Apparently, it's supposed to use more advanced technology, different from foldable phones currently released by Samsung and Huawei. I think that's the product the market is really keeping an eye on. As for Microsoft, it continued to fall yesterday, but after the earnings report, its stock has been fluctuating between about $500 and $550. I think in the next few days, we need to be careful to see if it breaks below that range. If it doesn't, I think it will continue to consolidate and then look for another opportunity to move up later. One major issue is that OpenAI has been a bit too aggressive lately, almost giving off the impression that it wants to go independent. How this will play out is still something to watch. But I think Microsoft is in a good position because right now it should still be OpenAI's largest shareholder. As long as OpenAI goes private, Microsoft will definitely be able to secure some investment returns from this. In addition, Meta dropped quite a bit yesterday, down 1.28%. It's been falling for several days in a row. I think one of the main factors is the TikTok situation. If the US really forces a sale, it's basically a case of either sell or get banned. If TikTok is sold, it won't be banned, but if it's not sold, it will be banned. After it's banned, the impact on Meta would be significant because TikTok's most direct effect is replacing Facebook's users and their engagement. So this could put some pressure on Facebook's advertising business. Still, looking at the stock, it's holding above 750. Basically, the gap from before hasn't been filled yet, so we're watching to see if it will fill that previous gap around 755. In addition, Tesla dropped sharply by 1.93% yesterday, mainly because there were reports that the Senate is investigating Tesla's autopilot and full self-driving systems. This means the regulatory risks are increasing, so the stock went down. Similarly, we see that Tesla also has a problem with its short-term deviation being too large. Actually, if you look at the major stocks among the so-called Magnificent Seven, most of them have this issue of excessive deviation. When the deviation is too large, there's a chance for a short-term correction, but it doesn't necessarily mean the stock is entering a bear trend. That's something important we want to clarify. As for Nvidia, after surging the day before yesterday, it dropped again yesterday. The main reason is that an OpenAI investment deal sparked concerns. There's talk in the market about circular financing. But I think, simply put, it's just that I provide them with investment funds, and then it turns into giving investment funds to a small startup company. If this startup takes investment money and uses it to buy back my products, there's a question: am I really investing in you? Or is this a disguised sales? I think in this case. But it doesn't work that way because the amounts involved aren't equivalent. The second point is the focus is on whether there are new products, new applications, and whether new people are joining. In other words, to put it bluntly, the key thing to watch is whether the Stargate project is actually being implemented and whether SoftBank or Middle Eastern investors are really putting money in and making an investment. That's what we should really be paying attention to. As for the current situation, after a big bullish candlestick on Monday, yesterday actually saw an engulfing pattern. Was it taken over by a bearish move and then dropped? Here, let's see if, short term, the market is moving sideways instead of directly dropping. There's a possibility it's just broad consolidation. Before Monday's bullish candlestick, I thought, when it first appeared, I saw it as an attack signal. But yesterday, it got pushed back down. Short term, no need to be too pessimistic yet. Let's watch longer and see how things go. It should still have a chance after this consolidation. Amazon also had a bigger drop yesterday. The main reason is recent investigations by U.S. regulatory agencies. Here, the Federal Trade Commission is investigating because Amazon's Prime membership, specifically Prime Day Prime membership, seems to have issues with its cancellation process. So, the FTC is looking into Amazon. Additionally, New York State issued a new labor law, and Amazon seems to react strongly to this. These are the reasons for the decline. But compared to others we just mentioned, Amazon's stock price is actually below the monthly moving average, so Here, what we need to pay attention to is whether, if it really falls below the 200-day moving average, there will be greater downward pressure for a correction. That's something everyone should keep an eye on. On another note, Intel had a rebound yesterday, rising to 2.02. This was after some news came out following the previous acquisition, so the market responded very enthusiastically, resulting in a big jump. I think after about 3 days of cooling off, things will probably calm down even more. Looking at it now, it seems like it might move sideways for a while before we see what happens next. But the main issue still lies in its IC design division. Their products are too outdated, specifically their PC or notebook CPUs. But what the market really wants now are GPUs and other products, so whether they can catch up in terms of design is a big question. Another key point is whether their foundry business can turn losses into profits. That's still a major issue. As for Oracle, you can actually see that Oracle is somewhat similar to Intel in this regard. So, will they follow Oracle's model? We're watching. Yesterday, Oracle had good news. They're still consolidating sideways. The bigger issue is that although there's been much positive news lately, have most of these positives already been priced in? Of course, among them, the first thing is the huge order from OpenAI is a positive, and the deal with TikTok is also a positive. In addition, collaborations with NVIDIA or other companies are positives as well. But here, we need to see whether these positives have already been realized. You know, most of the good news might already be priced in. So, this situation may still need some time to be digested, and it's possible that further consolidation will be necessary. That's where we'll leave it for now. Broadcom is trending upward. Yesterday, after earnings were released and the stock jumped, it stayed in high-level consolidation. The market saw significant selling pressure after a big rally. The most important thing is whether Broadcom delivers on its ASIC business. Whether they can boost revenue and their potential collaboration with Apple for a certain product remains uncertain. The integration of VMware, acquired earlier, is still ongoing. This caused the stock to drop, but the gap has held. Overall, Broadcom is consolidating at high levels. Now, let's talk about Micron. Yesterday, Micron's intraday price rose 1.09% to $166.41. Their earnings report was set to be released after market close. There was caution during the trading session. There was a relatively long upper shadow on the candlestick. After market close, the earnings report showed revenue of $11.315 billion, higher than the estimated $11.154 billion. GAAP EPS was $2.83 per share, better than the expected $2.68.4. After hours yesterday, the stock was up over 5% at one point. In early trading, it later returned to around flat or a slight increase of about 1%. Early in the session, it was up 1.5%, but as we'll see, By this morning, it had turned downward again. Let's talk about this first, because Micron is also a stock that has seen a significant short-term increase. Although the earnings report was good, the main point is that its future revenue really looks like it will continue to climb step by step, quarter by quarter. However, the stock price may have already priced in even more, so after the earnings report is released, there's a chance the stock will enter a period of sideways consolidation, waiting for the moving averages to catch up. Here, I want to point out that you'll notice a similar situation with many U.S. tech stocks. After a big short-term rally, there's often a need for some technical consolidation. But there's one more thing I want to mention. When it comes to outlook and guidance, we'll discuss the data with everyone when the time comes. Quickly looking at the Philadelphia Semiconductor Index, it had a slight drop yesterday, but there were still quite a few highlights. You can see that in the short term, the deviation from the moving average is still relatively large. The Nasdaq is the same, since it's also heavy on tech stocks, and the short-term deviation is quite significant. The Nasdaq 100 a similar situation, the S&P the same. Of course, one of the reasons tech stocks were relatively weak yesterday was because, including specifically pointing out that these stock prices are relatively high. Of course, this mainly impacts tech stocks with higher valuations, so it's no surprise that tech stocks were weaker. Compared to what was unexpected yesterday was the sudden weakness in tech stocks. The equal-weighted index saw a slight increase. Although there was an upper shadow left on the candlestick, it still performed better than the market cap-weighted SPX. So, that's what happened yesterday. It's very clear that large-cap tech stocks were being adjusted, so this had a pretty significant impact. The Dow Jones, the Dow was the weakest performer. If we look at it, it's basically moving upward along the 20-day moving average. So even though it dropped yesterday, its deviation from the average wasn't as pronounced. So, the correction might be minor. Next, let's jump ahead to what to watch out for, then discuss other things like the US dollar or other markets. First, macroeconomic data. Today, it's housing market numbers, the MBA mortgage index, a minor figure, then pending home sales, and building permits. But tomorrow, Thursday, and Friday, so tomorrow and the day after, we'll have more important data like GDP, initial jobless claims, existing home sales, and the University of Michigan Consumer Sentiment Index. That's the University of Michigan data for Friday, and another on Saturday. Also, on Friday, there's a PCE number. One correction. Previously, I mentioned a value needing revision. That's an annual revision postponed, not the PCE number. Tonight, the only speech from Daily. The main focus is tech stocks, as they weakened yesterday. The key is to see if that weakness continues, and if the decline gets bigger, that's more important. Of course, with the current changes in the market, especially with Trump, you still have to keep an eye on him. Now, why are we bringing this up and jumping ahead to talk about it? We want to remind everyone to pay attention. After Micron released its earnings yesterday, there might be a bit of a lull in earnings reports. After Micron's announcement, there shouldn't be any major economic data this week, and next week there aren't any important economic releases either, because we have to wait until October. Next week is September 30th, October 1st, and then October 2nd. After another week, starting October 5th, companies like Delta Airlines will begin reporting, and that's when the new earnings season kicks off. Between these two earnings seasons, after Micron's report, there really aren't any significant earnings announcements, at most, just some retail companies. So this is an earnings blackout period, and you need to pay special attention. During this blackout, there won't be new data like Micron's earnings to stimulate the market. At the same time, we just saw that NVIDIA, OpenAI, and Oracle are being questioned about whether they're boosting each other's performance. So, looking from this angle, if companies want to keep pushing the market higher, you need to see solid, tangible results, like actual funds invested or deals the market believes profitable. Otherwise, the impact will diminish over time. So, in terms of corporate activity, there's a chance to enter a lull in the short term. Next, focus might shift back to watching economic data. Inflation shouldn't be too high, nor employment too strong or too weak. These are things to note. Speaking of which, especially with the new earnings season, it might not really start until around October 10th, that is, after the 5th, or even after the 12th, when there will be more earnings reports. If you check the PA earnings news, you'll notice there's about a 10-day gap, or roughly 10 trading days, where there aren't many reports. Everyone should be aware that during this period, because there's less corporate news, the market's upward momentum might stall, or it could enter a consolidation phase. Just a heads up for everyone. Next, let's quickly take a look at the US dollar and compare it with other currencies. Yesterday, the dollar had a slight drop. The red bar on the far right isn't the dollar. The dollar's movement was actually the day before, which was Tuesday. On Wednesday, it rebounded. The main reason, I think, is that Trump didn't say there would be a rate cut in October, and his stance remains relatively neutral, maybe even a bit conservative. So, the dollar is looking pretty good here. But actually, U.S. bonds, specifically the 2-year, continued to fall, and yesterday the 10-year also dropped. However, today the 2-year kept falling, while the 10-year stabilized. As for oil prices, it's worth mentioning that Trump made some strong statements about Russia, calling for NATO to attack Russian planes and for Ukraine to reclaim all its territory and keep receiving ammunition. It seems like the Russia-Ukraine war isn't ending anytime soon, so oil prices have surged again. This week, oil prices continued to rise. Despite ups and downs, it's still trading in the $65 to $70 range. Even with an increase, it just moved back above the 200-day moving average. Challenging $70 isn't difficult. Why? Supply is still increasing, which has been the market situation. Short-term news might boost it, but overall supply, especially from OPEC+, remains strong and plentiful. That's the general market consensus, unless OPEC+ cuts production. If they cut, prices could break through the $70 to $75 range. So, keep an eye on that. Importantly, oil prices shouldn't get too high, or it'll affect inflation. Gold is still on an upward trend, but today's numbers show it moving sideways, mainly due to the Fed's comments yesterday. If the atmosphere is more tense, it seems that the sense of unease is higher, so gold prices have been supported. As for Bitcoin, it dropped yesterday. Today, it stopped falling and rebounded. The main news is that the SEC approved another ETF for a simplified listing. But I think Bitcoin seems to be stuck in a high-level consolidation pattern without any particularly strong or directional movement. Next, let's take a look at the performance of futures and the pre-market situation. Mainly, let's first look at the futures side. Futures have basically turned positive because around 6 o'clock, the S&P mini futures were still down, but now there's been a slight turn into positive territory. However, we're estimating a small rise of about 0.15 to 0.2, waiting for the main market to open since there was a drop yesterday. It's good that there's a rebound today, but we need to talk about some individual stocks. When you look at the declines, I don't think it's particularly great. First, let's look at this one here. This one, I think, if I remember correctly, is a metals company or something, Albion. I forgot exactly what company it is, but it's in the mining business. I think this one has a relatively large increase. It's a small one, and then this is Westinghouse. Westinghouse Electric's pneumatic company, EME, an industrial stock, performed relatively well. Then there's Power, PWR, likely energy related. ServiceNow, a software company, has gone up. Next is GM. Due to lithium mining, GM has a partnership. If the U.S. government gets involved, lithium's price and application might strengthen, boosting GM. Then there are oilfield service providers. Halliburton, not Harry Potter, it's Halliburton, went up, and then First Solar also rose, United Health went up, and Amazon rebounded after a bigger drop yesterday. Next is the manufacturer of Teradyne, so that one is up as well. Looking at it, actually, there are quite a few stocks that went up today. Among the yes and amp wink with tongue sticking out components, more stocks went up, but there's still an issue. Let's look at the declining sectors, this FCX. This one actually went down, but the news about copper is positive, and copper prices are up. This is Freeport, which is the largest copper mining company in the U.S. Also, we saw that Oracle didn't do well. This one turned downward again and looks relatively weak. Another one, Adobe, also didn't perform well. Also, before the market opened, we saw that Micron, MU, wasn't performing well in pre-market trading, but now it seems to have caught up a bit, and its losses appear to have narrowed. That's a good sign, because from what I just saw, MU's earnings report was actually pretty good, but if it had dropped too much today, it would have been a blow to the overall morale of tech stocks. So let's take a look here. I've been trying to find MU, but haven't found it yet. Here, we see it's not in the top 20 anymore. Good news. Before I started the live stream, I saw it was in the top 20. Now it looks 23 to 25, and earlier it was down 1%, but now it's less than 0.5%. Hopefully, during the main session, it can dip a little, because there's no issue. It just went up too much before. The earnings report was good, but if the reaction is too strong, it'll need to consolidate before it has a chance to perform. Looking at today, if things continue like this, the bigger problem is still with tech stocks, because Oracle is down. Also, we can see that a few other tech stocks are relatively weak. On the other hand, some sectors that are up seem to be performing in a more scattered way, and the gains are relatively large, but these blue chip stocks make up a smaller proportion of the overall market cap. The rotation among stocks is more obvious, which is actually a better situation. Next, let's take a look at some of your questions. As for Trump giving up on peace talks and just wanting to get out of the wars between the 3 or 2 countries, I don't really think that's the case. He actually tends to contradict himself when he speaks, and that's just how he is. And yes, as Anna also mentioned, peace in Israel is actually a big issue, because actually, the issue everyone has been talking about lately is Israel, especially the actions related to Palestine, which have been getting a lot of attention. Except for Wu Chang and the United States, everyone else has recognized it. But I think the key point is that the United States hasn't recognized it. If the US had recognized it, Palestine wouldn't be the problem it is today. In fact, I was discussing this with other colleagues, and we're probably on the same page. Israel's recent strikes have been quite powerful. There's no news about Gaza, and all the news that's been released is likely from Israel. According to indirect information, his attack has been quite powerful recently, and it's very likely we'll see success before the end of the year. That's why everyone is rushing to acknowledge him now, hoping to help him. However, without substantial military intervention, it's almost impossible to change the current situation. That's about it. So, let's get back to the point we're discussing today. What Bauer said yesterday wasn't the main reason for the stock market decline. It might have been a factor that pushed the decline further, as tech stocks were already declining. The biggest problem with tech stocks is that their short-term gains may have been excessive, and a correction is necessary. We're still optimistic about tech right now, but I'm still bullish on it. The biggest issue is that during the so-called earnings gap, it's possible that positive news isn't coming out because some of the positive news from coin purchases and partnerships has already been released, and the benefits are diminishing. In this situation, the technical indicators are showing a lot of gains, but there's a chance that there's going to be some period of consolidation. There will be a pullback here, but it won't be deep. The main thing is that as long as the moving averages gradually catch up, we're waiting for new corporate earnings reports and news to see if tech stocks can be pushed higher. As for the AI boom, it's still on. This wave is going to roll forward. It's just that when it really reaches the peak, it will only end at the tail end. That's all for today's discussion. Good night, everyone. If there are no further questions, I'll see you all tomorrow.
Our company has no improper financial interests in the individual securities recommended or analyzed. The information in this program is for reference only. Investors should make independent judgments, evaluate carefully, and bear their own investment risks. If you don't want to miss the latest market updates, be sure to turn on the notification bell and hit subscribe. In addition, we have plenty of great video content on both Facebook and YouTube. Don't miss out. In our group, we share in-depth explanations of global financial events with you every day.